What if your 1031 exchange looked perfect on paper, but one small name change caused the IRS to deny your entire 1031 exchange? The same taxpayer rule in a 1031 exchange is one of the most overlooked requirements. Most investors focus on identifying like-kind properties and meeting the 45 and 180-day deadlines, but they forget about one critical detail: ownership continuity. Under IRS rules, the taxpayer who sells the original property must be the same taxpayer who purchases the replacement property. Change that by using a different name, entity, or ownership structure, and you could end up facing a devastating tax bill. If you have any questions about the ownership structure within your 1031 exchange, my contact details are in the description below. Here's why the same taxpayer requirement matters so much. The IRS views each taxpayer as its own entity. If the property is sold by taxpayer A, but the replacement property is purchased by taxpayer B, that exchange isn't valid in the IRS's eyes, even if it's the same person behind both names. That mistake can completely disqualify your 1031 exchange, triggering capital gains, depreciation recapture, and state taxes you thought you deferred. Let's look at some common ownership challenges and some smart solutions. Challenge 1. An owner sells property in their personal name but wants to buy the replacement in an LLC for privacy or liability reasons. The fix: use a single-member LLC or a grantor trust. Since both are disregarded entities, the IRS still treats it as the same taxpayer. Challenge 2. An investor sells individually but wants to buy as part of a multi-member LLC. That won't qualify since a partnership is a separate taxpayer. Instead, structure it as a tenant-in-common ownership first, then join the partnership later after a safe holding period. And Challenge 3. Marital or ownership changes. Say one spouse sells before marriage and wants to buy jointly afterward. Allowing ownership either before the sale or after the purchase to maintain continuity. Violating the same taxpayer rule can derail your entire exchange. Even a small oversight like putting the replacement property in a different name can cause the IRS to reclassify the transaction as a taxable sale. That means losing your deferral and owing thousands or even tens of thousands in unexpected taxes. Understanding and preserving the taxpayer identity from start to finish is the key to keeping your 1031 on track. The same taxpayer rule is simple but powerful. The name on the sale must match the name on the purchase. Whether you're using trusts, LLCs, or changing ownership structures, keeping the same taxpayer consistent is what keeps your tax benefits intact. It's one of those details that can make or break your entire exchange. And that wraps up this video. If you're planning a 1031 exchange or have questions about the ownership structure within your 1031, feel free to give us a call. My contact details are in the description below.